Hi everyone, this is Group 25 and my name is May. There are 4 questions will be answered during this presentation. Here are the case of Gillis resistance of Luanon's hostile takeovers. Now, I'm going to introduce what is hostile takeovers. The term hostile takeovers refers to the acquisition of one company by another corporation against the wish of the former. During a hostile takeover, the acquiring company goes directly to the company's shareholders or tries to remove the company's management in order to get the acquisition approved. There are 2 reasons why Luanon took the actions. In the early 1980s, a large number of leverage buyout (LBOs) happened in the US, which were known as a wave of hostile merger and acquisition. Leverage buyout background and attribute profit target results in Gillis dilemma. This company we are presenting here is the biggest producer of blades, successfully resisted 3 hostile takeovers during this period. In addition, Gillis' case stands for large amount of threatened companies facing merger and acquisition. On the one hand, Gillis was the well cash flowing and relatively well management. On the other hand, it has an exorbitant value greater than its market value, so there was a profit margin for acquisition. By the way, Luanon attempted to buy the undervalued shares in exchange of extra profit through hostile overtakes, different value overtation, and operation target, which means that their core business were not completely matched.
Here is Chen Tang speaking. In the 1980s, Gillette experienced 3 kinds of hostile takeover. The first hostile takeover began on October 31st, 1986. Revlon officially began acquiring Gillette stock. On November 14th, without consulting Gillette management, Revlon made a tender offer to Gillette at $65 per share. Gillette rejected this offer, and on November 21st, Gillette repurchased the stock from Revlon at $59.5 per share. We can see on the date Revlon announced its plans of taking over it. There was a marketable increase in both the share price and the trading volume. After the first hostile takeover failed, Gillette signed a 10-year stock purchase agreement with Revlon. And in the end of 1986, Gillette conducted a 2-for-1 stock split to protect its own companies. In the first hostile takeover, Revlon gained the profits by selling stocks, and so despite the absence of the stock purchase agreement, Revlon made a second tender offer to Gillette on June 17, 1987 at $40.5 per share. Due to the same reason, Gillette rejected the offer again. 2 months later, Revlon made a tender offer at $47 per share. Gillette management rejected this offer, citing the acquisition undermining the stock purchase agreement. Until October 15, 1987, according to the United States Securities and Exchange Commission, the request for extension of the acquisition expired, so Revlon stopped the acquisition of Gillette.
Okay, this is Simone speaking. This is a part of function of hostile takeover. In this part, we mainly focus on how hostile takeover affect corporate governance. So let's see the first one, external pressure. It means only when interests are threatened will managers not be slack in work. EDC problem may be mitigated because once the acquirer have sufficient shares, they will elect new directors. And the poison pill means that target company will issue additional shares so to lead a rapid rise in the acquisition cost of buyers. And in 1985, Gillette reorganized the board of directors in response to hostile takeover, which is a staggered board. The next one is How does the company's management deal with the hostile takeover? We have some common defenses like poison pill and the staggered board, which has mentioned before. We also have white knight. It means a firm is invited by target company to save it from unfriendly takeover like hostile takeover. And the dual structure means voting power is invited to two classes, and one of which has superior voting rights to the other. Usually, the former is held by insiders. And as you can see, this is also one of the most important impacts on corporate governance.
Okay, I am Minto, and firstly, I will introduce the 2008 financial crisis. The recession is triggered by the subprime crisis, and the financial and real estate sectors are most affected. Then afterwards, the risk spreads from virtual economy to real economy, and the decline in the value of stocks has led to financing difficulties and bankruptcy. Such economic environment makes enterprises have perfect conditions for M&A activities. The first point is that the countries lose monetary and fiscal policies. The second point is that low-priced corporate assets. In other words, as a result of the financial crisis, the risk of direct investment in the industry increases and the willingness to reduce, and the sufficient liquidity environment makes it less and less difficult for enterprises to carry out measures and acquisitions. However, about COVID-19 economic downturn, the recession is caused by the inability of companies to produce due to the pandemic in this social environment. The enterprise is in trouble for production, then it will lead to fracture of capital chain. Next, the real economic collapse and the economy goes into recession. An enterprise with sufficient cash flow milks enterprise short of cash flow. And then they also have the two conditions. And the first point is the consumer industries build burnt. And the 2 point is that companies are in a strong position to make acquisitions. Unlike most recessions, this one has fundamentally changed the balance of companies, providing apparel opportunities for cash-rich firms to buy other failing firms.
This is Ritong Li. I'm going to talk about what are the similarities and potential difference in M&A activities between the 2008 financial crisis and the 2019 COVID-19 economy recessions. As we can see from the line chart, at the macro level, M&A activities have shown a downward trend in both 2 years. For example, according to the Margin Market Global M&A Trend Report, the activity of the global M&A market decreased by 6.9% in 2019. Also, M&A activity have decreased in 2 years. The reason and effects are similar and different. About the similarities, there are 3 points. The first point is the company being acquired caused the breakdown of the funding chain. The second point is both of 2 years M&A took place in an environment of loose monetary and fiscal policy. The third point is government often get involved in mergers and acquisitions. About the difference, there are also 3 points. In 2008, the capital chain was broken because enterprise could not finance, but in 2019, enterprises are unable to produce and thus the capital chain is broken. In 2008, the largest number of M&A took place in financial and real estate sector, but in 2019, the largest number of M&A took place in pharmacy, medical, and biotech sectors. In 2008, countries less affected by the financial crisis to acquire the countries more affected, but in 2019, countries less affected by the pandemic are acquiring the countries more affected.
Okay, here is Yana speaking. Next, I will introduce the impact of board gender diversity on merger and acquisitions. The first point, it can promote the process of merger and acquisition decision-making. Compared with the male directors, the female directors are good at listening and likely to compromise in the discussion. So increasing the women percentage can easier to reach an agreement on acquisition decision-making. And the second point, it can improve the acquisition oversight process. Female directors are more risk averse. Therefore, compared to all male boards with one or more female directors will be associated with more active oversight during the acquisition. And the board would pay more attention on the risk control nature of acquisition and the uncertainty of payoffs. But the gender diversity have a negative ratio with the number of takeover bid and the bid premium. This may be because the face of unknown risk and the benefits, female directors often choose to avoid risk or have lower confidence in the value estimation and the expected return of an acquisition. According to the research of Levi at 2040, as 10% of female directors increase, the number of takeover bid and the bid premium would decrease 7.6% and 30.4% respectively. And the last page is our reference. Thank you for your listening.